Good morning, everyone. Thank you for taking time out of your day to join us for our Inheritance Tax and Probate webinar. For those who don't know me, my name is Alex Robbins, tax partner here at Bishop Fleming, and member of our dedicated trust, inheritance tax and probate team. I'm delighted to introduce to you today two of my senior colleagues from my team. That's Olivia Down and Becky Hawkins, and they will both be providing you with an overview of the inheritance tax and probate systems, plus hopefully some useful tips for you to consider. Just before we start, we will not be taking questions during the presentation. So if you do have a question, please click on the Q&A icon at the top of your screen and note down any points that you would like to be clarified. We will then pick these up at the end of the session. So why are we holding this talk today? Well, never is the phrase, those who fail to plan to fail. Never has that been more relevant in the context of estate planning. So we are constantly facing questions from our clients such as, mum and dad didn't create wills, dad's just died, it's all a bit of a mess, what do I do? Or even, I've been really successful with my investments, but I don't want my family to pay any inheritance tax on those. The important point here is to plan, but also in the context of inheritance tax, to consider the things that are important to you. Is maintaining your lifestyle the thing that really matters to you? Can you both afford and want to give away assets? And also, are your financial affairs in order? And are you certain that your assets are going to pass to those you intend them to? Olivia and Becky will be providing you with some useful background information on these and give you pointers to help start that thought process. With that in mind, here's Olivia.
Thanks, Alex. First of all, I'm going to give a brief run through on how the inheritance tax system works. Inheritance tax, or IHT as it's more commonly known, is probably one of the most controversial taxes, and over recent years, receipts received by the revenue have been steadily increasing year on year. In the tax year 2021-22, HMRC collected around 6.1 billion in tax, and this was an increase of some 729 million from the previous year, and this equates to around about a 14% increase. IHT is charged at a rate of 40%, and this makes it one of the highest rates of tax charged. In addition, the nil rate bands have been frozen since April 2009 and will remain at 325,000 until at least the 6th of April 2027. And research indicates that by this time, it's anticipated that the average inheritance tax bill will be nearly £350,000. IHT is most commonly associated with being due when someone passes away, and in these circumstances, IHT will be charged on the value of your estate, which is in excess of your available nil rate bands. Your estate consists of everything you own, and this will include not only the more obvious things, say for example, any property you own or any investments, but also your belongings, so things such as cars, jewellery, antiques, even down to the clothes you're wearing. There are no tax-free assets for inheritance tax as there are for some of the other taxes, and this means that both ISAs and your primary residence will form part of your taxable estate. Every individual has a nil rate band of 325,000 and this is offset against the estate. As the name implies, the rate of tax charged on assets falling in the nil rate band is 0, and this band is therefore offset against your estate, a bit like the personal allowance. However, if the deceased has made any gifts, either to other individuals or into a trust in the 7 years before death, these gifts will use up the nil rate bands. If such gifts are sizable, it could mean that there is no nil rate band available to offset against the estate. In addition to the nil rate bands, individuals will also qualify for a residential nil rate band, and this applies if they leave their home to their direct descendants, so in other words, their children or grandchildren. And for the rest of this talk, I'll refer to this as the residence band. Individuals without children will miss out on the ability to claim the residence band relief altogether, although stepchildren and adopted children are classed as direct descendants. However, unfortunately, nieces and nephews aren't. The residence band is set at the lower of 175,000 or the value of the property in your estate. Although there are provisions in place to allow the relief to continue to be claimed where an individual has either downsized or perhaps sold their property and moved into care. The residence band also starts to be tapered if the value of your estate exceeds a threshold of £2 million. For every £2 that the value of the estate exceeds 2 million, the residence band is reduced by £1. And if your estate is large enough, the tapering provisions can mean that you will not be entitled to any residence band at all. However, it's important to note that the ordinary nil rate band, so the 325,000 that everyone knows, doesn't get tapered regardless of the size of your estate. Now, on death, any part of the estate passing to a surviving spouse or civil partner is exempt from a charge to inheritance tax, and this is because such transfers are covered by the spouse exemption. This can lead to the nil rate bands not being used on the first death. So, for example, if the deceased spouse had left their entire estate on death to their surviving spouse. Where nil rate bands are unused on the first death, they can be passed to the surviving spouse and used against their estate when they pass away. And this applies to both the nil rate band and the residence band. And it's important to note that for this to apply, a claim must be made on the second death. As a result of the ability to pass nil rate bands to the surviving spouse, for married couples, this means the maximum amount of tax-free allowance which can apply on the second death is £1 million. Now, this is made up of the two nil rate bands of 325,000 and two residence bands of 175,000. If, on the first death, some legacies are left to other people as well as the spouse, then only the unused percentage of the nil rate band would pass to the surviving spouse, because legacies left to other people who aren't the spouse would use up the nil rate bands. For unmarried individuals, the maximum amount of nil rate allowance available will be £500,000. Once the available nil rate bands have been deducted from the value of your estate, everything over and above those thresholds will be subject to inheritance tax at a rate of 40%. Now, as well as on death, it's also possible to trigger inheritance tax charges during your lifetime. Outright gifts to individuals, known as potentially exempt transfers or PETs, will give rise to an inheritance tax charge if they've been made in the 7 years before death. And this is often referred to as the 7-year window or the 7-year clock. Inheritance tax would be charged on these gifts at 40% on the excess of these gifts' value over and above the nil rate band. Pets which are made outside of the 7-year window are completely exempt from inheritance tax, regardless of their size. However, any gifts made between spouses are exempt from inheritance tax due to the spouse exemption, and these gifts aren't taken into account. In addition to making gifts to individuals, gifts may also be made into trust during your lifetime, and these gifts are known as chargeable lifetime transfers, and they can give rise to an immediate lifetime charge to inheritance tax if their value exceeds the nil rate band. Now, unlike pets, chargeable lifetime transfers are taken into account during your lifetime. And this means if you set up a trust for £325,000 today, this would use up your nil rate band for the next 7 years. This means if you set up a further trust within that 7 years, you would not have any available nil rate band towards the second trust, and everything put into the second trust would be subject to a lifetime charge to inheritance tax at 20%. After 7 years of setting up the first trust, you'd get your nil rate band back in full, and you'd be able to set up future trusts without an inheritance tax charge, obviously provided you didn't exceed the nil rate band that was available at the time. Another common misconception is that inheritance tax is only payable by the donor. This is the person who's making the gift. Whilst the donor does retain a liability for any inheritance tax due on gifts, the recipient of the gift also has a responsibility to pay any tax that may become due. Now, this can be particularly important where gifts have been made shortly before the donor passes away, especially if the donor has insufficient assets left in their estate to pay any tax due. And this can cause real problems, particularly where the recipient may have already spent the gift, say to purchase an illiquid asset such as a house. Where large gifts are being made, it's sensible to keep such gifts well documented, and in particular to make it clear who should bear the responsibility for paying any tax. And this can be done by inserting clauses into your will. Finally, taper relief can apply, which reduces the rate of inheritance tax payable on gifts made and which becomes payable in the 7 years before death. Taper relief applies once the gift has been survived by at least 3 years, and with the rate of inheritance tax being charged, reducing the longer the gift is survived. Now, inheritance tax planning is a highly specialised area and is certainly without a one-size-fits-all solution. However, we've tried to pull together some tips and advice on helping you reduce your tax liabilities and to make your estate planning as simple as possible. Although I must stress this isn't a substitute for individual advice. I'll now pass you over to Rebecca for the first of our tips.
There are various exemptions which can reduce your inheritance tax charge. There's an annual exemption available of £3,000, which reduces the IHT value of gifts. The exemption is set against gifts in chronological order through a tax year, and any unused exemption can be carried forward in the following tax year for 1 year only. So, for example, if no gifts were made in the 2023 tax year, the exemption would be £6,000 in the 2024 tax year. However, the current year exemption has to be used first. So if gifts of £4,000 are made, there'll be no exemption to carry forward to 2025. You can also make regular habitual gifts out of your income, free of inheritance tax, provided they leave you with sufficient income to maintain your usual lifestyle. Examples of these gifts include life assurance premiums or regular gifts like Christmas or birthday presents. There's no monetary limit on this exemption because it's based on your own position, but you need to establish a pattern of giving and demonstrate that you've made a commitment to that pattern. A good way to set this up is to create a standing order of a regular amount, and it can be helpful to document the intention with a letter. This is a really useful relief because it prevents excess income building up to be taxed later on. Gifts to a spouse or civil partner are completely exempt. The only exception to this is if the recipient spouse or civil partner is not UK domiciled, in which case only the first £325,000 of the transfer is exempt. The spouse exemption can't apply to cohabiting partners, regardless of how long they've lived together. Gifts to UK charities are exempt with no monetary limit. This exemption also applies to other bodies, such as political parties, housing associations, and national heritage bodies. You can make outright gifts of up to £250 per year to as many individuals as you wish. This is the small gifts exemption, and it's cumulative for each individual. So, for example, 2 gifts of £200 to the same individual would exceed the limit, and the exemption no longer applies to that individual. Therefore, this can't be used alongside another exemption. Wedding gifts are exempt up to a certain limit, depending on your relationship with the newlyweds. These apply per marriage or civil partnership. So if a father gifts £5,000 to his daughter as a wedding gift, he can also gift £1,000 to her spouse and claim exemptions for both gifts. Payments for the maintenance of your family aren't treated as transfers of value. This covers maintenance of your current or former spouse or civil partner. It also covers maintenance or education for a child until the later of them reaching 18 or ceasing full-time employment. Finally, reasonable provision for the care or maintenance of a dependent relative is included. Similar to the gifts out of excess income exemption, what is reasonable is based on the transferor's situation. There are also reliefs available for owners of agricultural or trading businesses. These reliefs are very complicated, and specific advice should be taken to check whether you qualify. If you do qualify, it's really important that you continue to qualify and take advice on any planned changes to make sure that the relief won't be lost. Not all transfers will qualify for exemptions, and Olivia will now discuss in more detail.
So you may want to give away assets, And by giving away assets, this will reduce the value of your estate for inheritance tax purposes, because the value of your estate would have reduced by the value of the item gifted away. Such gifts will be pets, which, provided you survive them by 7 years, will be IHT free and outside of your estate. So, for example, if you gave away an asset worth £100,000, you would save inheritance tax of £40,000 after 7 years. It can therefore be inheritance tax efficient to give away assets that you think may increase in value going forwards. Whilst gifting assets can be efficient for inheritance tax purposes, it's important to understand that often such gifts will not be free of capital gains tax. Gifts of things like property and shares are chargeable assets for capital gains tax, meaning gifts of those assets to family members will be treated as a deemed market value disposal, regardless of the fact you have not received any cash proceeds. And this will therefore give rise to a capital gains tax charge. Transfers between spouses and civil partners, as with inheritance tax, are exempt. So what can you do about the tax charge if you wanted to gift assets to your children? You could consider using a trust to defer the capital gains tax charge. When assets are gifted into a trust, it is still a market value disposal for capital gains tax. However, the tax rules allow you to defer the capital gains tax charge that would otherwise apply by using something called holdover relief. Holdover relief must be claimed jointly by both the donor, who is the person making the gift, and the recipient of that gift. If holdover relief was claimed, the trustees would acquire the assets with your original base cost, and this means that no capital gains tax charge would arise on the gift of the assets into the trust. It's important to note that the gain doesn't simply disappear. It's just deferred until the asset is physically sold later on. If the trustees were to sell the asset, their capital gain would be higher, as they would have taken over your base cost. However, it's also possible to claim holdover relief if the trustees were to transfer the asset back out of the trust to one of the trust beneficiaries. This allows you to get assets into the beneficiary's hands, say your children, without having to pay a capital gains tax charge. Now, I need to point out here that if assets are valued in excess of the nil rate bands, there could be an inheritance tax charge on the excess. You could also consider giving away assets which are specifically excluded from a charge to capital gains tax. And this includes decorations for valor, unless you've paid for it yourself, national savings certificates and premium bonds, shares and securities held in an ISA, passenger road vehicles, and this includes vintage or antique cars, and wasting chattels. Now, these are assets, physical assets, with a predictable life of less than 50 years. And machinery is always regarded as having a life of less than 50 years. And this includes things like antique clocks, watches, and even shotguns. Also, chattels with a market value of less than £6,000 are also exempt. Now, it's important to note that to be effective for inheritance tax purposes, any gifts must be absolute and you cannot retain any benefit personally going forwards. If you do, the gift is known as a gift with reservation, and for inheritance tax purposes, its value would remain in your estate until such time as you cease to retain a benefit. Examples of this would be things like giving away a valuable painting but keeping it in your house, or perhaps giving away a property but either continuing to live there or to receive the rents from it. The revenue don't consider gifts to be gifts with reservation if you're virtually excluded from benefiting from it, or where you pay a market rent for the use of the asset gifted. I'm now handing you back to Rebecca, who's going to talk about wills.
60% of adults don't have a will, and the most common reasons are because they're married and they assume it will all go to their spouse, so they don't need to worry about it. But this puts a lot of responsibility on the surviving spouse to write a will soon after you pass away, which they might not be in the right frame of mind to do straight after a bereavement. Or they think they don't have anything worth inheriting, but you might still have something important that you'd like to pass to a specific person, like a family heirloom or a pet. I'd like to think anybody would be lucky to inherit my dog, but it's easy to underestimate the massive lifestyle change this could mean, and it could happen suddenly at a time when that person's grieving. Wills are important because they name your executors, who will be responsible for dealing with your estate. This makes the probate process easier than following the intestacy rules, which apply when you die without a will. You should consider your current executors and whether they're still appropriate, for example, their age and location. Professional executors can be used, and this would take some of the pressure off of family members. Professional executors include both accountants and solicitors, and Bishop Fleming are able to offer this service. If you have children under the age of 18, you can leave clear instructions in your will for their future care and who their guardians will be. A will can settle arguments before they begin about what you would have wanted. And it's important to note that marriage can revoke a will in some cases. This can be particularly important if you're getting remarried for the second or third time, because your previous will could no longer be valid, and your estate could be subject to the intestacy rules, which may no longer give sufficient provision to your children. Whilst a divorce doesn't invalidate a will, it does treat your ex-spouse as deceased, so does a legal separation. And the rest of your will may not be appropriate. For example, it could lead to children inheriting assets earlier or unintended beneficiaries. And of course, if you're not yet officially divorced, your ex-spouse could still get your assets. We recommend that you review your will every 5 years or after a major life change to ensure it's correct and up to date. A letter of wishes is a document that can be drafted to accompany your will. It can provide important guidance to the executors dealing with your estate. It's not legally binding, and it can be easily changed or reviewed. It can include a more detailed account of how you wish your assets to be distributed or utilised, and it remains confidential after death. So unlike the will, the beneficiaries aren't entitled to see this document. You should make sure that your letter of wishes doesn't duplicate or contradict your will, because your wishes may be disregarded. Whilst we don't write wills, we can help to make sure that the structure is tax efficient, and we're able to recommend a will writer. You can structure your will to leave at least 10% of your estate to qualifying charities, which will reduce the IHT rate to a flat rate of 36%. The rules surrounding this are incredibly complicated and difficult to get right. Again, this is something that we can help with. If you're not intending to make such a large gift to charity, you might wish to leave a specific monetary legacy, which in light of some tax cases are less likely to be challenged by a charity, whilst a percentage of the residue could be. Following death, it can be possible to alter the terms of a will if they're not suitable, or to make it more tax efficient. So, for example, to skip a generation. And this can be done by entering into a deed of variation. There's a strict 2-year time limit, and beneficiaries can only give up their own entitlement. If you die without leaving a valid will, there are complex rules which set out how the estate will be distributed. These are called the rules of intestacy. Unmarried partners, stepchildren, friends and charities aren't provided for by the rules of intestacy. In most usual circumstances, so for example where you leave a spouse and children, the spouse would get the first £270,000 personal property and half the remaining estate. The children would get the other half. It's important to note that if the couple aren't legally married or in a civil partnership, then everything would go to the children. Some overseas marriages can be an issue here. There are different ways of owning a property jointly, and it's important to check how yours is held. Some people assume that it will pass to the surviving spouse, and this isn't always the case depending on your ownership structure. Assets passing to surviving owners, for example jointly held bank accounts, don't count for the intestacy rules. So if assets in your sole name are worth less than £270,000, then nothing will pass to your children. An example of where this can be an issue is if one or both spouses has children from a previous relationship and no wills. With small estates and second marriages, the intestacy provisions could mean that your now adult children from your first relationship might not inherit anything. We've also seen assets divided up between many distant cousins, and it can be very time-consuming and expensive to track them all down. The laws don't take into account how well you knew the person inheriting your assets either. It's split equally depending on the number of people at that level, regardless of which one sent you a Christmas card each year. It's possible to rearrange the way the estate is distributed, but all parties who are due to inherit must agree. It's also possible to apply to the court to make a claim if you were dependent on them financially, but this would require legal advice, adding complications and costs. The rules also determine who is responsible for dealing with your estate as your personal representative. This could end up being a distant relative who doesn't know you, and the rules don't take into account any wishes you may have about who should inherit your assets. Even if you've looked at the intestacy rules and think they deliver the result you want, bear in mind that your loved ones will inherit more quickly if you leave a valid will, partly because it can expedite the process for paying IHT, which Olivia will cover next.
So it's always worth checking both the makeup of your estate and also the contents of your will to check that there's sufficient cash or liquidity to pay any inheritance tax which may be due. If there isn't, this can cause problems, and this was demonstrated by a recent tax case. The deceased, a Mrs. Raboni, passed away owning some shares in a property. Her will instructed that her friend should be entitled to occupy the property for the rest of their life, after which it should be left to Mrs. Raboni's nieces and nephews. Unfortunately, Mrs. Raboni's savings were insufficient to settle all of the inheritance tax liability, and it was not really appropriate or desirable to sell the property due to the terms of Mrs. Raboni's will allowing her friend to occupy it. Neither did her friend have sufficient assets to settle the IHT personally. The outcome was that Mrs. Raboni's heirs ended up paying the tax out of their savings, rather than selling the property to pay the tax, which would probably have been the correct course of action, but not what Mrs. Raboni would have wanted. Now, this is perhaps something which could have been avoided had the right planning been considered in the first place. Any inheritance tax which is due on an estate starts to accrue interest if it remains outstanding after the end of 6 months after the month in which the death occurs. Currently, HMRC's interest rate for late paid IHT is 6.5%, and this is rising to 6.75% from the 13th of April. It's also of note that in order to obtain probate and get the appropriate authority to sell property investments, the executors need to pay all of the tax due. Now, this can create a chicken and egg scenario, as property may need to be sold to release funds to pay the tax, but to sell the property, probate needs to be granted to enable the property to be sold. Where estates are reasonably illiquid, and this is where they've got lots of property, it may be worth considering insuring against future IHT liabilities. Broadly, you would take out an insurance policy which pays out a sum on death, and which can then be used to offset some or all of the IHT bill. Provided the policy is held in a trust, when it pays out, the proceeds do not form part of your estate, but they can be used by your family to pay the tax due. Payments to purchase the policy will be chargeable lifetime transfers and would use up your nil rate band unless you're able to make them out of your excess income. It's also possible to pay inheritance tax on some assets over a period of 10 years by instalments. Interest is charged on any outstanding tax, so it can make this an expensive option. Instalments are usually available for illiquid assets such as houses or shares in owner-managed businesses. And finally, as a last resort, executors can often fund the payment of tax by taking out a special executor's loan. Now I'll hand you back to Rebecca.
When we carry out probate services, we often come across some problems which would have been avoidable with the right planning. Most people don't know what the process is until they have to go through it, and so this often means that people's record keeping isn't set up in the most helpful way. The key issues that crop up regularly are sole bank accounts are frozen on death in most circumstances, and this means that even spouses aren't able to access the accounts until probate is granted. This can also create a big issue for sole traders, where the business still needs to pay expenses. Jointly held bank accounts pass directly to the other named account holders. Some people aren't aware of this and incorrectly assume that they can leave their share to a third party. The automatic passing of the account can be challenged, and this can be complicated and costly. Record keeping is very important, especially with the increase in paperless systems and assets. For example, if you have an online-only bank account or cryptocurrency, your executors may not know this exists. We've produced a useful document that you may find helps to keep this information in one place, and this is available on our website. Your executors are responsible for reviewing and identifying gifts made in the last 7 years, including any exemptions that may apply. It can be really difficult and time-consuming, both personally and if you're using a professional. Keeping clear records on the purpose of the gifts can be really useful. Where the gifts out of income exemption has been used, the executors will need to record your income and expenses over the last 7 years. So if you can have all income and expenses through one bank account, this makes the process much quicker. When beneficiaries are named in a will, it's helpful to include identifying information. This could be a date of birth or previous address. It's also important to keep a note of any change of address, so your executors can track them down. It's possible to use a tracing agent to locate beneficiaries, but of course there's a cost to this and it can delay matters. If you keep contact details only on your phone, bear in mind that your executors may not have your passcode to access this. It's also important to get specific advice relevant to your individual circumstances. We sadly see instances where people have misunderstood something that they've read online, or a friend's passed on advice that they received personally, and the action they've then taken hasn't been effective. I'll now pass you back to Olivia for our final considerations.
So I'm just going to chat through some miscellaneous points that we've not mentioned elsewhere. And the first type of planning I'm going to talk about is something called deathbed planning. This type of planning is specifically aimed at married couples or civil partners where one of them is terminally ill. And the first of these is looking at protecting the residential nil rate band. So by keeping your estate below 2 million, you can ensure that you qualify for the residence band. Even if your entire estate is passing to your spouse, if your estate exceeded £2 million on death, the residence band would still be restricted. Now, if the estate of the poorly spouse is over the 2 million threshold, they could consider gifting property to their spouse before they pass away to reduce their estate below the threshold. And this would ensure that the residence band is protected and would give them tax relief of £70,000. Gifts of property to anyone, even just before death, are still effective for the purposes of reducing your estate below the residence band threshold. Although if such gifts are made to people other than your spouse, they would be treated as failed pets for the actual inheritance tax. The alternative, or the other side of this, is making use of the capital gains tax uplift. So assets passing on death get a tax-free uplift for capital gains tax purposes. And this works by the person inheriting those assets receiving them with a base cost equal to their probate value, which would be the market value of that asset on death. This provides planning opportunity, and consideration could be given to transferring those assets, which if sold or gifted away now would give rise to a large capital gain, to the spouse who is unwell. The unwell spouse would then leave those assets back to the other spouse in their will, and after death, the surviving spouse has inherited those assets back to themselves with an uplifted base cost. And this provides them with a planning opportunity to gift assets on to, say, the children without having to worry about a large capital gain. Provided the gift onto the children is survived by 7 years, you will have passed assets on to them free of inheritance tax by making use of both the spouse exemption and tax-free uplift. Now, second marriages can also cause problems when looking at drafting wills, because you will want to ensure that your current spouse is provided for, and also that your children from your first relationship receive a fair value of your estate if you were to die first. If your will left everything outright to your spouse, you are relying on them honouring your wishes and making sure they include your children within their own wills. And sadly, it's not always the case that the children and the second spouse will get along, or the second spouse may have children of their own. Now, if you want to guarantee your children receive a fair share of your estate, you could leave assets outright to them in your will. However, this could mean that your current spouse isn't left with enough to live on. Now, one way around this is to incorporate something called an interest in possession trust in your will to benefit your spouse. This means on death, all of your assets will pass into the interest in possession trust. No inheritance tax will be due because the surviving spouse is the main beneficiary of this trust and the spouse exemption would apply. The trust would give the surviving spouse the right to income from the assets in the trust. So if the trust owned a share portfolio, for example, the income arising from that would go to the spouse. The spouse would also be entitled to occupy any property owned in the trust, meaning they could continue to occupy the family home. However, the trust is structured such that the spouse is not entitled to use the capital, and this is the bricks and mortar in effect. Instead, the capital is protected in the trust until the spouse dies or such earlier time as the trustees decide. And at that point, the assets in the trust will pass directly to the children of the first spouse, under the terms of the trust and not under the terms of the surviving spouse's will. This guarantees that capital can pass to your children and can ensure that your spouse should not be left with insufficient income to live on. This type of planning can also work to protect part of the estate from care costs. Assets passing into trust for the surviving spouse are legally owned by the trustees and not by the surviving spouse. Now, this means that if the surviving spouse were to require care later on, whilst their own assets would need to be used to fund care costs, those assets held in the trust are not part of their estate for this purpose. Now, care is needed with such planning as this because the value of any interest in possession trust is added to the estate of the surviving spouse when they pass away. And the only way around this is if the trust assets have already been passed on before they die. Pension freedoms have existed since April 2015 and relate to defined contribution or money purchase pension schemes. Now, it's possible to leave your pension pot to the next generation free of inheritance tax. And the reason this transfer is free is that usually your pension pot won't form part of your estate for inheritance tax purposes. With the March budget removing the lifetime allowance for pension pots, this option may now be even more attractive. Now, it's important to note that whilst the tax rules allow this to happen, it's important to check that your individual pension provider themselves will or can allow the pension pot to pass to the next generation. So that sums up everything we were going to cover today, and I hope you found our tips useful. But I wanted to point out that in addition to the above tips, we are obviously able to offer bespoke planning solutions. As you may have gathered, inheritance tax planning can be a really complex subject, and there are other more complex planning solutions available, which are too complicated to include in a webinar such as this one. This can include specific IHT solutions, which allow you to get assets out of your estate, whilst either providing you with a tax-free income stream or future access to the capital, investing and ensuring entitlement to business reliefs and agricultural reliefs, such as business property relief and agricultural property relief, and family investment companies, which are fast becoming a popular alternative to traditional trusts. We'd be really happy to discuss any of this planning in more detail on a one-to-one basis. And if interested, you should initially contact your usual Bishop Fleming advisor or one of us on today's talk. I'll now hand you back to Alex to summarise.
Thank you, Olivia and Becky. That was really, really good. Hopefully everyone enjoyed that session and has picked up a few interesting points to think about. Now, before you all rush off and phone your local representatives at Bishop Fleming to start your inheritance tax planning, we do have a number of questions that have been published, and I will apologise now, we are not going to have time, unfortunately, to go through all the questions today, but those we don't, we will make certain that we get back to the people who've asked the question and hopefully answer any queries that are outstanding. Now, one that's been very common in terms of questions is about the slides, the presentation. We will be sending out a link so that you can go back over the presentation and pick out the points that you think you might want to clarify in your own mind and or have missed. So that's the first point. So just quickly running through a couple of the questions. First one, we're a married couple with no children, one brother each, and several nieces and nephews. We will have a significant inheritance tax liability on second death. We are very comfortable but do not feel we have surpluses for gifts or trusts. Do we have any inheritance tax mitigation options? Well, there's an open question for perhaps Olivia.
There are various inheritance tax options available, and as I very briefly touched on at the end, there are some more complex solutions that would perhaps allow you to get capital out of your estate whilst retaining some kind of income stream to that to the assets given away. So it would be possible, but it would involve some sort of complex planning.
Thank you, Olivia. Next question. I'm unmarried, but live with my partner. We've got wills, leaving everything to each other. When I die, will there be inheritance tax to pay? I think we'll pass that one to Becky.
Thanks. Potentially yes, depending on the value of your estate. There isn't an exemption for transfers between unmarried partners, unfortunately, so this will use up some or all of your nil rate bands. And there isn't the ability for the surviving partner to inherit any unused nil rate band as well. So that's something to just be aware of.
Okay, thank you. And Becky again. If we are married but hold our house as tenants in common, does the 175,000 residential allowance transfer, i.e. the total allowance for the surviving partner is still £1 million?
Yes, so how you hold the property doesn't affect the residential nil rate band. The key thing is who you pass it to. So it shouldn't prevent any access to the residential nil rate band.
Okay, thank you. Right, Olivia, your turn. My mum lost her husband, in brackets my dad, in 1996, her second husband in 2016. Is the tax-free estate £1 million, including property, or does she get two transferred spousal allowances? So £1 million or 1.2 million?
Unfortunately, it's the £1 million. Whilst she would be able to use any transferable nil rate bands from her first husband, you can only have one lot of transferable nil rate bands, so the maximum would be £1 million.
Okay. And here's one that was already answered in the presentation, but I think it's quite an important one to just reinforce the point here. The question was, what's the status of a SIP in an estate? Becky?
Olivia might be better to answer that one.
Okay, fine. Olivia.
So, a SIP, because it's held in a pension fund, it doesn't form part of your estate for inheritance tax purposes. A bit like a trust is usually outside of your estate. So it means it won't form part of your estate, and depending on what the SIP rules allow you to do, you should be able to pass it on inheritance tax free. And again, if you want any specific advice on that, I would point you towards our financial advisors, Bishop Fleming Independent Financial Advisors.
Right, this one I think is for you, Becky. Gifts with reservation of benefit. The question from Peter is the tax implication of adding children as part owners of one's main residence, ? i.e. the capital is not accessible until after death, but part ownership past 7 years prior to death.
Yeah, so the issue with that is that you're retaining a benefit potentially to that property if you still live there. So the gift isn't necessarily effective for inheritance tax and could stay in your estate at the point that you pass away. The other issue is that it can result in double tax charges, which does get quite complicated. But yeah, we'd be happy to discuss that in more detail.
Okay. Olivia, just swap it around. Could you please explain which gifts can be used together, e.g. £3,000 per year plus gift from income plus £250?
So the £250 has to be used in isolation. It can't be used alongside the £3,000. But the gifts out of income can be used sort of separately to all of that because it's a specifically separate exemption. And I think it's important as well to not overlook how important the gifts out of income relief is, because if you've got significant income, it does allow you to give away significant chunks of cash, inheritance tax free.
Okay, and just to extend that question from another post here, can the £3,000 per annum gift allowance be backdated if it has not been used in previous years?
So it can't be backdated as such, but if you haven't used your full £3,000, say in year 1, it can carry forward 1 tax year to the second tax year and be used in year 2. But in year 2, it's the year 2 annual exemption that's used first.
Brilliant, thank you. Okay, and we'll do the last question now for you, Becky. If elderly married parents have different incomes, how does the gifts out of surplus income work in practice, i.e. one parent has surplus income and one does not, but treat their money as joint?
Oh, that's a good question. So it can still apply to, it's based on your individual circumstances. So it's not necessarily a requirement to look at your spouse's income in terms of the one that perhaps hasn't got the surplus, as long as you're able to basically maintain your standard of life and not dip into capital, etc. So yeah, you might just want to be kind of mindful that it might mean you're ending up perhaps covering a bit more of the costs, and so that should be taken into account when you're looking at your own excess position.
Great, thank you. Okay, we'll call it a halt there. Thanks again to Olivia and Becky for the presentations. They were really good. If anyone does have any more questions, please contact us. We are very happy to talk, whether that's us 3 here today or whether that's your usual Bishop Fleming contact. Just please do contact us. Again, we will be sending out a link to this presentation today, and any questions we haven't just answered just now, we will be getting back to you as soon as we can. So thanks again for joining us and have a good remainder of the day. Thank you.